Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Fiscal woes, the Treasury sell-off eases as the big, beautiful bill makes its way through Capitol Hill. Pushing for more deals, the U.S. reportedly urges the EU to make unilateral tariff cuts. Presidents Trump and Ishiba hold a phone call. And the Trump administration blocks Harvard from enrolling international students while forcing current students to transfer. 3 consecutive days of losses after the big one earlier this week. We are on track for the biggest weekly loss since the Liberation Day week. Do we try to climb back after that? We're a little changed on both the S&P and NASDAQ futures this morning. Russell 2000, that outperforms after underperforming most this week. But most of the concentration, and rightly so, has been on this bond market and specifically the long end of the curve. Now, some of the biggest amounts of the pain that we've seen have eased. At one point yesterday, we were at 5.15% on your 30-year yield. We give a lot of that back, and we do more so this morning, down by 1 basis point. On the totality of the week, we are higher by just under 8 basis points. Those are your overall markets. Let's look at some of the stocks to watch. With that is Bloomberg's Joe Easton. Good morning, Joe.
Hey, morning, Danny. Take a look at Deckers Outdoors today. The stock sliding in the pre-market. We're down around 16% for the maker of both Hoka running trainers and also UGG boots as well. I'm told the weakness is in those shiny, colourful Hoka trainers, which aren't selling as many as expected. The UGG boots, meanwhile, doing pretty well, but that stock sliding a lot in the pre-market today. Then we're also watching uranium stocks and other nuclear power shares on a report saying Trump is going to rejuvenate the industry with some executive orders citing some defensive concerns around other countries like China. Take a look at those ones, though. Oklo up 19%, Centrus Energy 22% almost. Going to see some big moves in nuclear energy today. And then finally, Intuit, a bit of volatility in that one after the close last night. This is in the tax industry, so it's tax software. Not the most glamorous industry, but got a big unch on the screen. But take my word for it, that's going to be a big mover. Keep an eye on Intuit. As usual, all of this on the Before the Bell opening wrap, available on the terminal shortly.
Yeah, it would be fitting that a boring tax stock is having a boring movement, at least for now. But, Joe, we will keep our eye on it for any change. That is Bloomberg's Joe Easton. Thanks so much. Now, later this hour, in just a few moments, we're going to be speaking to Marvin Barth of Thematic Markets. Later in the hour, we'll also catch up with Sitara Sundar of JPMorgan Private Bank. Now, I mentioned that the concentration has been on the long end of the curve so far this week, and rightly so. Look at what it has done. At what point intraday, hitting 5.15%. But on the totality of the week, again, that's over 5 days, but if you look so far what we've done, we are just around 8 basis points climbing despite all of the concerns. Now, Marvin Barth of Thematic Markets weighs in on what the bill could mean for the economy, because, of course, this has been concerns over the tax bill coming through D.C. He writes, quote, "The big, beautiful bill, if passed in similar form by the Senate, will further cement the unsustainability of the U.S. fiscal path, increasing the fiscal deficit to a whopping 8% of U.S. GDP in 2025 and 7.8% in 2026. Marvin Barth joins us now. He is the founder of Thematic Markets. Marvin, so wonderful to see you. And look, this is a bond market that so many people have said maybe could be the thing that reins in what's happening, but it's been an orderly sell-off and under 10 basis points. Is this the market saying that we are fine, giving Congress the green light to go ahead with this tax bill?
Well, Danny, it's a great pleasure to be back with you. I think markets are telling Congress and all the American people that actually you are at the end of your ability to continue to run these deficits at will. This has been going on for more than a decade now. We're just putting a capper on it at this point. And it's shocking that term premia hadn't risen more. In fact, much of the rise that we've seen is really just an adjustment of the negative term premia we built up over the last decade. It's certainly still well below what we saw in the 80s and 90s. So it's not to threatening levels yet, and maybe that's why, to your point, markets are quite orderly, but it certainly is a warning shot.
But will it get to that, Marvin? Will it get to threatening levels? Or is it a bond market that's going to let Washington, D.C. get away with it?
I've always had this view of the U.S. as those old Wile E. Coyote cartoons where, he's running off the edge of the cliff and only after he's well over it does he realize that it's a straight drop down. Unfortunately, I think that's going to be the situation, Danny. But before that happens, I think a lot of other countries are going to get run off the cliff. Whether you like it or not, the U.S. still is the anchor of the global bond market, and everybody else comes second. And we're starting to see that in markets, whether it's in Europe, where curves have also steepened very dramatically, or most dramatically in the long end of the Japanese bond market.
Marvin, I think that part is so interesting. But how do you judge what is the push and what is the pull, whether it's all coming from the U.S.? In the case of Japan, they have their own monetary woes to deal with the BOJ that's pulling back from a bond market with a lot of issuance after owning 50% of it. We learned in prior instances that the carry trade and what happens in Japanese rates has big global ramifications. Is some of that possibly going on here, too, as it relates to the U.S. bond market?
Well, there's definitely a lot of carry trades that are being unwound. You don't have this type of movement in global rates markets without some sort of existing carry trades being unwound. And we're seeing that across different markets, to exactly your point, in different parts of the curve. I think the key point here is the one that you started with, that it does continue to be very orderly, and at this point we should at least take a lot of solace in that. That won't always be the case if all of these governments continue to try and fund large fiscal deficits, which, by the way, given that everybody's talking about raising defense spending, is actually likely.
Marvin, just to the point of the big, beautiful bill we're going to get, just how stimulative do you see it being?
Well, I think this is one of the things that markets really underestimate. And in fact, I think markets have been far too pessimistic on U.S. growth anyway. Everyone hears these broad tariffs and they think this is going to be a disaster. It's going to be terrible for growth. I've done the number crunching on this. It's actually not that bad. The tariffs, even if you assume full retribution and the worst of the Liberation Day tariffs, you're really only talking about subtracting about 1% from U.S. GDP, just to give you some perspective there. What this bill does, because those tax cuts are very front-loaded in the bill, it actually adds 1.6 percentage points of GDP of tax cuts. And that has a fiscal effect that I estimate is about 2.5% in this year and next year. So this is actually a big boost to growth, even when you take account of the spending cuts that are embedded as well, which unfortunately aren't that big.
So I guess, Marvin, what I'm trying to understand is if this is a big boost to growth, but it's also flashing an amber, maybe later a red light for the bond market, is this good or bad for risk assets?
Well, that's a really good question, but I'd separate the two different effects that are going on here, right? I think the key point is absolutely, this is a tremendously bearish bill for bond markets across the whole curve, right? Because you're getting a powerful growth effect, which means that actually the Fed is unlikely to cut this year or next year. In fact, the next move might be a hike. So you have that weighing on the whole curve, but then you do have this term premium aspect at the end of the curve. That's the part that's negative for risk assets. And so that's why you're seeing these back and forth movements in stock markets.
Marvin, I just want to end on this. I want to get your thoughts on it, because I noticed this in your research that I think many of our viewers would be interested, that you do expect President Trump to push through higher tax rates for the upper income earners. Why do you think that?
Well, I think if you look at even this tax bill, it does actually push through more cuts for lower income earners. You've got the main tax cuts are for tips for overtime earnings. Those are capped, by the way, for higher income earners. You have more income for seniors. And he's actually recently broached the idea of raising taxes on the highest income earners. And if you listen to Steve Bannon, who many think is the sort of intellectual architect of the whole MAGA movement, he really is talking about raising taxes on the rich a lot. This is a conversion of the Republican Party from the party of capital to the party of labor. That is what Donald Trump represents, and I think a lot of people miss that point.
Marvin, this has been a masterclass. It is always a pleasure to have you on. Please come join again soon. That is Marvin Barth of Thematic Markets. Let's now get you some other top stories that are trending on the terminal this morning. The Trump administration has ordered Harvard to stop enrolling international students. The administration says the university's leaders allowed protests to create a, quote, unsafe environment. International students must transfer or lose their student visas. The group currently makes up about 27% of the student body. Reuters reporting that Los Angeles investment firm is in discussions to buy out OnlyFans in a deal that values the site at $8 billion. OnlyFans, which soared in popularity during global COVID lockdowns, has been in talks since at least March with Forest Road Company about a transaction. Terms are unknown. Spain's government is pushing ahead with a controversial proposal to hit non-EU residents with an 100% tax when buying homes. Maybe give up on buying that Spanish villa. The bill aims to promote access to housing and tackle a brewing crisis in the property market. There is an exemption for foreign business people or professional workers who live in the country. Coming up, the House passes Trump's big, beautiful bill. We'll have more on the road ahead coming up next on your Bloomberg Brief.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big, beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
That was House Speaker Mike Johnson speaking yesterday. Senate Finance Chair Mike Crapo is the Republican who will shepherd the bill through the next stage. He told reporters yesterday the House didn't go far enough on tax cuts. For more, I'm joined by Bloomberg's EMEA News Director, Rosalind Matheson. So, Ros, the self-imposed deadline of July 4th, does it look like this bill will make it there in time?
Well, possibly not. I mean, what we're hearing is maybe this will go to a vote in August. The clock is ticking either way because of the imperative around the US debt ceiling and the need to get some sort of bill through. I mean, as Donald Trump has called it, it's a big, beautiful bill. According to him, it's definitely big. And that's the challenge, is there's so many moving parts in this bill, and it narrowly got through the House, but it's going to have a complicated path in the Senate, and you can expect that Republican senators will look to change aspects of the bill, which could slow it down quite considerably. And that's all around everything, including the expedited moves around Medicaid. They're a bit worried about what that might do coming into a midterm election with voters. You've got some pushing for even bigger tax cuts, even bigger spending cuts, and a lot of complexity there. So it's the path through the Senate is very unclear, and the time around that is very unclear. But as you say, Donald Trump is pushing very hard and personally getting quite involved in trying to direct Republican senators and others to get on board with this bill very quickly. Maybe August, but obviously the clock is ticking.
Well, it's going to be an incredibly busy month and a couple weeks in Washington, D.C., because it's not just the self-imposed deadline for taxes, it's also the self-imposed deadline for trade when some of these reciprocal trade tariffs will start to come up in July. Roz, where do we stand on negotiations?
Well, as you say, there's a long list of countries still to negotiate with, and we've seen obviously some overarching frameworks of understanding that have been reached, including with the UK. But that was arguably the easier stuff because the UK is a country that has a surplus with the US. Getting trade deals with places like the EU, for example, or some countries in Asia, India, Japan, is more complicated. We do know that Donald Trump spoke with the Japanese Prime Minister. That seems to be in a general conversation versus something specific around the argument around tariffs and coming in, of course, to their meeting in the G7 summit next month. But we do know the Japan trade negotiator is also on his way to Washington for meetings, and the question is, what is the path forward for Japan, and what do they take from the arrangements that have been made so far with China, the UK and so on, and how do they go into those conversations. But realistically, a long list of countries to try and get sorted and not so much time to do so.
It does seem, Roz, that the continual thorn in the side of the Trump administration side is the EU. The FT reporting on a letter that U.S. Trade Representative Jamieson Greer is getting ready to send his trade counterpart about pushing them to make unilateral tariff reductions. Is there any sign of appetite for the EU to do something like that?
Well, we know from our own reporting the EU's taken quite a strong stance on this, and they've sent counter proposals back yet again to the US. And what we know is they're expecting to have a phone call today between Greer and the EU trade negotiator Šefčovič. And it's in that conversation we're expecting the US to say no, essentially, to the latest EU proposal. And so we're back to the drawing board there. I mean, the EU has made it very clear they have red lines, just the US does, and they're a much bigger economic bloc for the US to deal with than just, say, doing a deal with the UK. And the EU has been very clear that they don't want to budge on certain things, including around agriculture. And so that relationship is much more complicated, and we'll see how that call goes and what the path forward is from there. I mean, we know they're talking, but it just doesn't seem like there's a lot of progress being made.
Roz, thank you very much for that update. That is Bloomberg's Roz Matheson. Up next, we'll discuss some of the biggest winners in finance and hedge fund world. Marvin Havard gets a boost from tariff turmoil. Pershing Square snaps up Amazon stock after a better price plunge. We'll get you our latest exclusive reporting on the hedgies. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning and what's making headlines on various outlets. First up, on the FT, leading with the Trump administration's move to bar Harvard from enrolling international students. The administration revoked the university's student and exchange visitor program certification effective immediately. Trump has been deepening his attack on elite institutions, accusing them of promoting woke ideology and failing to tackle anti-Semitism. Next up, the Wall Street Journal has this on their front page: the biggest banks in the U.S. exploring whether to team up to issue a joint stablecoin. The intention: fend off competition from the crypto industry. Journal sources say the conversations have involved companies co-owned by JPMorgan, Bank of America, Citi, Wells Fargo, among other large commercial banks. And on the New York Times, hundreds joining an exclusive dinner with dreams of crypto fortunes in mind. Apparently, President Trump hosted a dinner last evening at his Virginia golf course. The highest paying customers of his personal cryptocurrency were there. Protesters outside were condemning the event. Now, elsewhere, some exclusive reporting from Bloomberg. Jane Street generating more than $2.3 billion in net revenue from equity derivatives last year in India. But its lucrative trading strategy has sparked a probe by regulators. Joining us now is Bloomberg's Charlie Wells. And Charlie, if I'm not mistaken, this is a strategy that there had been a lawsuit around because traders left and reportedly brought it with them to other places. Clearly, though, the strategy is still working.
That is, so to the tune of $2.3 billion in net revenue, as you mentioned, Danny. And I mean, it's interesting. The Indian stock market had been in such a dynamic place last year that it's no wonder that we're starting to learn about some of the significant earnings that even U.S. financial firms have started to take there. And options trading really have boomed since the pandemic in India. So this really is sort of starting to show an increasing focus for India, not just for U.S. firms, but for Jane Street as well, where that India revenue or that India earnings was responsible for 1/10 of their net revenue. So a huge boost there.
And we got to give our, while we're speaking, Charlie, our hedge funds a big old hat tip this morning because they've come out with a lot of exclusive reporting on performance. How have some of these macro hedge funds done in what has been a very tumultuous April?
Danny, so hedge funds doing what people pay hedge funds to do, which is to make money in any environment. So we're seeing some of these firms, particularly with funds, particularly with an Asia focus, come out ahead last month. So Brevin Howard MB Macro Fund, they had a 3% in that very tumultuous return, in that very tumultuous month of April. Southern Ridge's Summit Macro Fund up 1.2%. So this is despite all the volatility that we saw, despite all the uncertainty. Now, it's tough to know exactly exactly what they were doing right there, but it seems like a lot of right-way bets on rates, on volatility, on oil, and on gold.
We're also seeing some reporting that Bill Ackman's Pershing Square buying a new stake in Amazon. What's going on there, Charlie?
So this was, again, making the right move at the right time. So after a 31% decline in that Amazon share price, Pershing Square saying that they made a new stake in Amazon. And on this sentiment that Amazon, particularly that cloud business, could kind of withstand any weather that we're seeing. So doing that sort of thing that investors like hedge funds to do, which is to look for investments that they think could bring in money in any environment.
Charlie, thank you so much for your wonderful reporting this morning. That is Bloomberg's Charlie Wells. Now, coming up on the show, volatility abound. We've seen a 30-year yield hit above 5% and still hanging around their equities, on track for their worst week since April 2nd week, the week of reciprocal tariffs. But Sitara Sundar of JPMorgan sees opportunities in stocks ahead. Is it time to be thinking about the upside case? We're going to be catching up with Sitara next. You're watching Bloomberg Brief on this Friday morning. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Fiscal woes, the Treasury sell-off eases as the big, beautiful bill makes its way through Capitol Hill. Pushing for more deals, the U.S. reportedly urges the EU to make unilateral tariff cuts. President Trump and Prime Minister Ishiba hold a phone call. And the Trump administration blocks Harvard from enrolling international students while forcing current students to transfer. Now, just barely 3 days of losses after yesterday, we turned it around. We started the future session positive. That has sunk into losses just over the past 30 minutes. Your S&P 500 futures and NASDAQ down by about 0.2%. We are on track for the worst week for equities since Liberation Week. But the concentration has been on this bond market. Long end yields have started their recovery, and they attempt to do so further this morning, now down by 2 basis points at just above 5%. At one point, we were at 5.15% in this bond market. So certainly more easiness coming through as the big, beautiful bill passes. Part of Congress passes the Republicans, now on to the Senate. Let's get you some stocks to watch this morning. Back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we've got to start with these nuclear stocks, seeing double-digit gains across this sector this morning, and it is a bit of a political story as well. Trump said to be looking to do executive orders to rejuvenate the industry in order to counter some production over in China and other countries, using a bit of a defence meaning for this. So we are seeing gains around 19% in Oklo, also Centrus Energy up 22%, set to be probably the best performing sector we'll get today. Then over in consumer, Deckers Outdoor not selling enough of those shiny coloured Hoka trainers. I've got a couple of pairs of them myself. Other trainers, sneakers are available, of course, but that one down 18% at the moment. The Ugg boots really strong, thankfully, but it is those Hoka trainers not doing so well in terms of the running market, down 18% almost for that one. Then Ross Stores potentially is going to need to cut prices even more after a weak earnings report. That's the takeout from a few analysts today. The orders, the sales at the discounter actually missing expectations. Potentially, we might see a bit of a read across in TJ Maxx, not TK Maxx as we call it over here. You might see a bit of weakness over in those ones. Ross Stores declining, Deckers declining, consumer potentially going to be a weak spot this morning, Danny.
Joe, I one time learned why it's TKX in the UK and not TJ Maxx. Apparently it was like some sort of issue with a different company already having that name. So there you go. There's your fun fact for your Friday.
Enlightened me. I've been wondering about that for years. You finally solved it. Thank you.
There you go. My kind of half knowledge of it. I tried. Joe, thank you so much. Bloomberg's Joe Easton. Have a great weekend. All right. The pain is starting to ease in the bond market. We can see that this morning with 30-year yields down 2 basis points. So does the bull case for equity markets get stronger? Our next guest writes, while we expect equity markets to hit new highs next year, there will be volatility around the way. We will use any bouts of volatility to leg into opportunities into areas of the market that provide portfolio resilience. Joining us now is Sitara Sundar, head of alternative investment strategy at JPMorgan Private Bank. So wonderful to see you this morning,
Nice
Sitara.
to see you too.
So all-time highs. Is it time to start thinking about the bull market case? For so long, we've been concentrating on the negative catalysts.
So I think one of the most interesting things, look, when we talk about portfolio resilience, we just released our mid-year outlook, and the tagline of it and the title of it is comfortably uncomfortable, because there's a confluence of different things that are happening right now. We need to interpret what trade policy means, what fiscal policy means, what that means for deficit, what that means for the long end of the curve. But I think sometimes, given everything that's happened and the volatility that's happened over the past several months, we forget about the positives that are out there, the deregulation agenda, the pro-business type of agenda that we likely might see. So we think over the next 12 months, the markets will make new highs and the equity markets will make new highs. And we are constructive on not just the U.S. markets, but non-U.S. markets as well, Europe, Japan, and that need for global diversification. But there will be, I know we talked about this last time I was on the show too, there's going to be a difference between the headline and the index level versus what's happening under the hood. Even if you look at our price targets, at least within the United States, it's mid-single digits, but we are expecting a pretty decent amount of upside in pockets of technology. Think about software, especially the enterprise software names, where you're getting recurring revenues, but many of the valuations of these really strong growth-oriented companies are still trading at multiples that are below pre-COVID levels. That growth is not yet being appreciated by the market, given everything else that's going on right now, where you're seeing that price get pulled down, we think unfairly so. And the other side of it is financial. Some of these more value-oriented areas where, if you think about deregulation, financials is going to be one of the biggest areas that are going to benefit from that.
So we're finally concentrating on what the Trump administration has been trying to say, which is deregulation and tax cuts. But in terms of fiscal stimulus, that had been much the story for U.S. exceptionalism last year, that you had this fiscal boost. Are we back to that? Do you dust off your U.S. exceptionalism, tech reigns supreme kind of trades?
So I still think that there's a need to be balanced. I do think that obviously, the U.S. exceptionalism trade was very strong at the beginning of the year. We still believe in technology. We still believe in a lot of the strong players within the United States. But I don't think that we can discount other parts of the market. We're seeing stimulus spending within Europe as well, in terms of what we're seeing out of Germany. And we do believe that defense spending and a lot of the spending that we're seeing in that space are going to shore up those markets as well. So I don't know that we can say one versus the other, but it's a little bit of the rising tide is going to lift all boats, but there's still a need to be selective. And then the other thing that I will mention, because we did talk about portfolio resilience a bit, there is still a need when you think about the volatility and you think about the risks that are there. There are risks on the downside when you think about inflation and the need to hedge against that. And we're still seeing some volatility on the long end of the curve. So when we're thinking about portfolio resilience and the traditional 60-40 type of portfolio, we actually are talking to our clients a lot more about the alternatives part of their bucket. A lot of the areas like infrastructure, for example, because you get that kind of resilient income that is actually inflation protected and doesn't have as much of the duration risk when you think about the long end of the curve. So you're getting that type of resilience on the alternative side of the portfolio as well.
Is there any scenario that could bring back the long end of the curve as that useful hedge, or do you just basically write it off for the rest of the year?
I don't think you can write it off. There's always going to be a place for core fixed income. There's always going to be a place for certain types of duration. We are, focusing a little bit more on the belly of the curve. I don't know that you can write it off. But when we think about portfolios over the long run, we always want to ensure that different parts of your portfolios are pulling different levers to hedge against the multiple scenarios that are out there right now, right? We talk about, even in last earnings season, you had so many companies that were coming out talking about the different probabilities and the different scenarios that were out there and the different earnings outcomes based on those scenarios. In a very similar way, when we're talking to clients about investing for the long run, we talk about probability weighting and scenario weighting their portfolios to see, based on all the confluence of factors right now, what do we think is going to be the best use of your next incremental dollar? And when we're talking about that, infrastructure, even we were talking about hedge funds a little bit earlier, the relative value and macro parts of the portfolio where you're leaning into less correlated return streams and less correlated to the public side of the market.
Well, so in the idea that you can't just buy everything, you have to be more choosy. What do you do with retailers at this moment? We got a lot of earnings. Target and Lowe's didn't look great, but you had Walmart, Home Depot, BJ Wholesale. A lot of those talked about a resilient consumer and people still buying. What is your read on consumer and consumer-related stocks right now?
We still feel okay about consumer spending. We still feel okay about the health of consumer balance sheets. We're starting at a pretty strong starting point and an elevated starting point. So we do feel like they can stomach some of the blow if we start to see tariff-related impacts feed through to increase in pricing. However, if you're asking me about what is our feeling about consumer discretionary stocks and staples and the role that plays in a portfolio, we're leaning a little bit more into the secular parts of the economy. So like tech is within that bucket. Comm services to a certain extent is within that bucket too. And then when you think about the more value-oriented side, we're leaning a little bit more into where we have clarity as to what that next 12 months is going to look like in areas that are a little bit less sensitive to the tariff-oriented risks. And financials is part of that conversation, and industrials too, to an extent.
Yeah, Sitara, this has been so interesting. Really great to have you in.
Nice to have you.
Sitara Sundar of JPMorgan Private Bank. Please enjoy the rest of your Friday and your weekend. Coming up, the Trump administration bans foreign students from Harvard. We're going to look at how and why and the impact next. You are watching Bloomberg Brief.
We look forward to the Senate's timely consideration of this once-in-a-generation legislation. We stand ready to continue our work together to deliver on the one big beautiful bill, as President Trump named it himself. We're going to send that to his desk. We're going to get it there by Independence Day on July 4th, and we are going to celebrate a new golden age in America.
Speaker of the House, Mike Johnson, speaking after passing President Trump's landmark tax bill on to the Senate. Now, Senator Mike Crapo, chair of the Senate Finance Committee, told reporters that he is determined to expand on the tax cuts in the bill. For more, I'm joined by Bloomberg senior Washington editor Michael Shepard. So, Shep, we go to the Senate now. How does it seem like we will indeed meet the self-imposed deadline of July 4th?
Well, rather than deadline, it might be thought of better as a goal. They really would like to get this done by the symbolic date of July 4th, but that's an ambitious timeline. The Senate is not used to working with that kind of speed. And as you noted, Senator Mike Crapo would like to make some changes to this bill. He sees a higher ceiling for tax cuts in his version of the package. And he would also like to make some business breaks, including bonus depreciation and research and development incentives permanent as part of whatever discussion he has. He is setting a line that he does not want to see any changes from what the House passed to the state and local tax deduction cap, which was raised in what was passed earlier this week to $40,000. And that is something that would appeal, to, of course, to a lot of lawmakers from blue states, but you don't have nearly as many Republicans from those regions. So it's a different equation there. The deadline they really face, of course, is August, and that is when we get closer to the X date. And this bill also contains language that would raise the U.S. borrowing limit by another $4 trillion and give them a little bit of leeway when it comes to budgeting for the next few years at least. And that is when they would really have to act by past the deadline. And speaking of the bond market, there are some misgivings that were hanging over the effort to pass the bill in the House. And we'll expect to see those surface again as it moves forward in the Senate. We saw the long end of the curve getting a little dicey and tense. We saw, as you mentioned, rates rising for 30 years. And investors are concerned that there might not be enough adults in the room. As one person we had interviewed earlier in the week said, when it comes to paying attention to deficits and debt, this is expected to raise deficits annually and raise the U.S. debt burden significantly. And that is what fueled Moody's decision to pull the credit rating, AAA credit rating it had on U.S. debt.
I mean, it is pretty amazing how orderly it's been given the Moody's and the tax debate going on, Shep. But I mean, it's going to be so busy in Washington, D.C., because it's not only a July self-imposed deadline or goal for taxes. It's also trade, too. Things come due in July as well. What are those discussions currently looking like?
Well, that's right, Danny. And July 9th is the day when U.S. trading partners have to either agree to some sort of deal with the U.S. to avoid the reciprocal tariffs snapping back at higher rates. Remember, on April 9th, the president said, hey, look, we'll hit pause on those higher rates that were unveiled on April 2nd. And of course, he hit pause in part because of signals from the bond market that all those tariffs might pose an economic risk, both in terms of recession and inflation. Now, those discussions are unfolding now between a number of trading partners. Later today, the top EU trade negotiator will hold discussions with Jameson Greer by phone. This is ahead of a face-to-face meeting next month. And the U.S. is going to make its case that the EU hasn't quite done enough in these talks. It wants to see more concessions, and it would, in particular, on some non-tariff barriers that it has seen in these talks.
And next, a very busy month. Shep, thank you so much for your insight this morning. That is Bloomberg senior Washington editor Michael Shepard. Now, elsewhere in D.C., the Trump administration's fight with elite colleges has risen to an unprecedented level. The latest move, banning Harvard from enrolling international students. Harvard President Emeritus, it is a Friday morning, Larry Summers spoke to Bloomberg about the move.
This is vicious. It is illegal. It is unwise, and it is very damaging. Why does it make any sense at all to stop 6,000 enormously talented young people who want to come to the United States to study from having that opportunity?
For more, we're joined by Bloomberg Daybreak editor Mark Perrier, who joins us now. Mark, what has been the reaction to this ban on foreign students at Harvard?
The reaction has been very strong, a lot of shock and confusion among students scrambling about what to do next. The university saying that they'll fight the ban, or it's unlawful. We're still waiting to see what they'll actually do, but a lot of shock and confusion. This story has been on the front page of every major newspaper today. Harvard, loved, respected, the most famous university in the world. This escalation in this battle between Trump and the university, it's just on another level.
To that point, Mark, part of the idea of U.S. exceptionalism had also been the exceptionalism of our universities and the output of students and research at it. Does this change that?
Potentially, yes. There is a fear this will impact on the talent pipeline in the U.S. You may see students perhaps avoiding going to the U.S. for their university studies or their PhDs, and often stay in the U.S. to do research. We need to see if there is contagion here. Will this spread to other universities? The situation is developing, very fresh. There could be a pullback on this, but I think everyone is in a wait-and-see mode.
All right, Mark, thank you very much for this very fast-changing story. That is Bloomberg's Mark Perrier. Now, elsewhere, Bloomberg has learned that OpenAI is looking at the Asia-Pacific region for future data center sites. It also follows a massive deal developing with a data center in Abu Dhabi. Joining us for the latest is Bloomberg Daybreak Europe anchor Tom McKenzie. Tom, what do we know?
Yeah, Danny, of course, as you say, this follows the commitments, the announcement that OpenAI will be leading that investment in the UAE with a data center potentially up to 5 gigawatts. That's enough power, for example, to power the whole state of Minnesota. It would require 5 nuclear power stations to power data centers of that size. They've never built anything that size before. There's nothing in the US that compares. It will take time, but what it does is underscore the unrelenting ambition of OpenAI to steal a march in terms of the innovation lead and to bake in their products on the software side along with their hardware partners in the UAE, with now that look to the Asia-Pacific region as well. So they will be visiting. We know senior executives from OpenAI next week will be on the ground in countries like Japan, South Korea, India and Australia to work on Stargate projects, the kind of thing that you've seen in the UAE, and replicate that in the Asia-Pacific region. This is about ambition for OpenAI, and it's about making sure they can continue to take advantage, frankly, of the lead that they have on innovation and make sure their software is getting used by those populations and by the governments, and that they have the hardware to support that alongside with their partners like NVIDIA, Oracle, of course, and Cisco Systems on the networking side.
Tom, also in tech headlines, we've seen the Trump administration really push Apple to build in the U.S. instead of elsewhere. It seems that there's some reporting that Apple is ready to defy Trump on that matter.
Yes, and this comes down to China. And China is part of the story in terms of some of the skepticism you get from some Trump administration officials around what is happening with OpenAI as well. China ties into that. There is some concern amongst the China hawks that there's an offshoring of US innovation and US technology to partners that could leave that exposed to China. And that takes us to what's happening with Apple. Apple's partners in India continue to invest. Reporting from the FT, Foxconn, the maker of most of the components that go into Apple's iPhones, the largest producer of iPhones themselves, is expanding $1.5 billion additional dollars in the Indian market. India already produces about 20% of the iPhones for Apple. They get about 20% from there. By the end of next year, all iPhones into your market in the US, Danny, will be coming from India. That's what we understand. This despite, as you say, Trump last week saying, look, he's had a conversation with Tim Cook. He wants Tim Cook to invest in the US markets. He wants those products to be made in the US markets. We know about the supply chain constraints and labor constraints to actually making that happen. Apple is investing about $500 billion US dollars over the next 4 years in the US, but that will be more focused on chips. They're a long way from doing anything on iPhones in the US. So we'll see if that becomes a tension point as Apple tries, of course, to hedge its supply chains into India.
All right, Tom, thank you very much for the latest tech reporting. That is Bloomberg's Tom McKenzie. By the way, just want to bring you a breaking news item in the past few moments that Bulgaria has cleared a crucial hurdle that will allow it to join the EU, the euro adoption. It would be only the second country in the past decade to adopt the euro since the euro's formation. Again, this would be at a time when people seem to be looking at alternatives for the dollar and, of course, mean a lot for Bulgaria and ease of use and investing in that country. So, again, Bulgaria getting closer to clear a major hurdle to adopting the euro. Now, coming up, we're going to wrap up your week. We'll see what's ahead. We have more Fed speak heading into your long weekend. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up as we head through the long weekend. Congratulations, you have just almost made it. New home sales and building permits data, that comes at 10 a.m. Eastern. We're also going to get some Fed speak from Musalem, Schmid, and Cook. That happens throughout the day. The Treasury market will also be closing early at 2 p.m. Eastern ahead of the Memorial Day weekend. So, hey, if you're a bond market trader, you get an early start to your weekend. And you probably want that, considering the week we've had. I just want to show you what the long end of the curve is doing internationally, because it's not just the U.S. that has experienced pain. We've specifically also seen higher yields in Japan and the U.K. We're down across the nations 1 basis point in the U.S. Japan down nearly 13, the U.K. by 1. For Japan, we saw the highest 30-year yield since the notes were introduced in 1999. For the U.K., the highest yields we've seen since 1998. We did hear from Michael Hartnett over Bank of America, his latest note, buy the dip in long ends of the curve in the Treasury, because he does believe that Washington, D.C. is going to get it together when it comes to the deficit. We'll see whether or not that actually happens. But again, we are still above 5%, 5.02. At what point does it impact the equity market? It hasn't been, but we are on track for its worst week since April 2nd. Gold is still moving higher. Maybe that becomes a replacement in your portfolios. All right, that is it for your Bloomberg Brief on this Friday morning. Surveillance takes it from here. This is Bloomberg.